Let's be honest. Trading a small account is one of the hardest challenges in the financial markets. Not because the market is too fast, not because your strategy is weak, and not because you lack intelligence. It's because your emotions are louder than your rules, and your expectations are bigger than your balance. Every trader enters the market with the same dream: to grow, to flip, to multiply. But very few understand that before any account can grow, the trader must grow first. A small account exposes every weakness you have: your impatience, your fear, your greed, your need to win fast, and your desire to prove yourself. You don't learn discipline with a big account. You learn it when every dollar matters. You don't learn risk management when you're comfortable. You learn it when one wrong move could wipe you out. And you don't become a professional because of profit. You become a professional because you survive the emotional pressure that destroys most beginners. Small accounts force you to face the truth. The market doesn't reward confidence. It rewards consistency. It doesn't reward hope. It rewards discipline. It doesn't reward those who want to get rich fast. It rewards those who are willing to master themselves first. Most traders blow their accounts not because they lack knowledge, but because they never learned how to trade within their psychological limits. When your position size is too big, your mind can't think clearly. Every pip feels heavy, every candle feels personal, every loss feels like failure, and that emotional pressure is what destroys good traders before they ever become great. But here's the part most people never hear: a small account is not a disadvantage, it's a training ground. It's where discipline is built. It's where emotional control is shaped. It's where consistency is formed. If you can master yourself with a small account, if you can execute perfectly even when the money is small, if you can remain calm when your risk is small, then you are already further than most traders who only rely on luck and big deposits. Today, I'm going to show you exactly how to think, act, and trade like a professional, even if your account is small. Because profit doesn't start with capital. It starts with psychology, discipline, and the right position size. This is the message every struggling trader needs to hear. So if you're ready to stop trading emotionally and start trading intelligently, let's begin. Here's the truth nobody wants to admit. Trading a small account is more emotional than trading a large one. Not because the market changes, but because your brain does. When you have a small balance, every trade feels like a test. Every loss feels like a setback. Every win feels like a lifeline. But this emotional roller coaster doesn't happen because you're a bad trader. It happens because your position size is too big compared to what your mind can comfortably handle. If you risk too much, even a good setup will feel stressful. If you risk too much, every candle movement feels dangerous. If you risk too much, you can't think like a professional, because your brain is in survival mode. A trader who is emotionally overwhelmed cannot follow rules, cannot wait for confirmation, and cannot execute consistently. This is why so many traders blow accounts, even when they understand the strategy. You must understand one core principle: your position size determines your emotional stability. Every professional trader, from hedge funds to prop firms, follows the same rule. Risk small enough to stay calm, because calmness produces clarity, and clarity produces profit. Mark Douglas taught something powerful: your job as a trader is not to control outcomes, it is to control yourself. If your lot size is too big, you will be controlled by fear. If your lot size is too small, you'll be bored and forced to overtrade. Your job is to find the balance where your mind feels safe, and your strategy can operate without emotional interruption. This is the psychological shift that changes everything. To grow a small account, don't think big, think consistent. Don't try to double your balance, try to protect it. Here are the rules professional traders use, even with small capital. 1. Keep risk flat. Risk a fixed percentage, usually 1% or less per trade. Small risk keeps your brain calm during drawdowns. 2. Don't chase setups. A small account makes traders impatient, but patience is your advantage. Trade only when your rules are met, not when your emotions are hungry. 3. Accept small growth. This is how real accounts grow, not through one big trade, but through a series of disciplined decisions. 4. Journal everything. Write your entries, exits, emotions, mistakes. Patterns will emerge, your psychology becomes visible, and once visible, it can be fixed. 5. Respect stop losses. Treat your stop loss like your seatbelt. You don't remove it when driving faster, you secure it tighter. When you follow these rules, something powerful happens. Your account becomes safer, Your mind becomes calmer. Your growth becomes measurable. Here's the mindset shift you must adopt. Small accounts don't require big trades. They require big discipline. Profit doesn't start with money. It starts with emotional control. Consistency doesn't start with wins. It starts with rules. And mastery doesn't start with flipping accounts. It starts with respecting the process. If you learn how to trade a small account with precision, discipline, and patience, you will have every skill required to handle a large account when the time comes. So if you're struggling right now, don't give up. You're not behind. You're in the stage where real traders are shaped. Keep your risk small, control your emotions, follow your rules, and grow slowly. Remember, you don't need a big account to trade like a professional. You need the professional mindset first. Thank you for watching, and stay disciplined, stay patient, and trade smart.